Oil prices witnessed an upward trend on Tuesday as market participants reacted to heightened concerns over possible supply disruptions in light of the escalating conflict between Russia and Ukraine. At the same time, traders and analysts were carefully weighing the impact of upcoming U.S. economic data, particularly job figures, on the future course of interest rates set by the Federal Reserve. The geopolitical tensions and economic uncertainties combined to create a volatile environment that pushed crude benchmarks higher. According to early trading data, Brent crude, the international benchmark, rose by 37 cents, or 0.54%, reaching $68.52 a barrel by 0617 GMT. Meanwhile, U.S. West Texas Intermediate WTI crude climbed $1.01, or 1.58%, to settle at $65.02 a barrel. The simultaneous rise in both benchmarks reflected the ongoing concerns that energy supplies could be disrupted if the Russia-Ukraine conflict further intensifies. Russia, one of the world's largest energy exporters, plays a critical role in supplying oil and natural gas to global markets, particularly to Europe. Any escalation in conflict that threatens the security of these supply routes tends to push prices higher, as markets factor in the risk premium associated with geopolitical instability. The Russia-Ukraine conflict has already been influencing oil markets for months, but recent developments have heightened fears that a larger-scale escalation could disrupt not only direct Russian exports but also the broader global supply chain. Analysts note that sanctions, countermeasures, or even damage to infrastructure could severely affect supply, leading to shortages and price surges. Energy traders are particularly attentive to reports of heightened military activity near critical transit points, as disruptions in these regions would have immediate repercussions for European and global energy security. Adding to the complexity of the market outlook is the anticipation of U.S. jobs data, which will be released later this week. This data is crucial because it serves as an indicator of the health of the U.S. economy, the world's largest oil consumer. Strong jobs growth could signal robust economic activity, thereby boosting demand for energy in the months ahead. On the other hand, weak job numbers could point to a slowing economy, which might reduce oil demand but also raise expectations for interest rate cuts by the Federal Reserve. Rate cuts, in turn, often stimulate economic activity by lowering borrowing costs, which can ultimately support higher oil consumption. Market observers are therefore caught in a balancing act, weighing the possibility of reduced demand against the risk of constrained supply. This tension has created significant volatility in oil markets in recent weeks. Traders are not only monitoring the conflict in Eastern Europe but also keeping a close eye on U.S. economic policy, as both have the power to shift the trajectory of prices in the short to medium term. The current pricing also reflects broader market sentiment that global oil demand remains steady despite ongoing uncertainties. The post-pandemic recovery, though uneven across regions, has generally supported energy consumption. In the U.S., travel and industrial activity have remained relatively strong, supporting domestic demand for crude and refined products. Meanwhile, in Asia, demand growth is still driven by China and India, though China's economic slowdown in certain sectors has raised questions about the sustainability of this demand. Energy analysts point out that the oil market is particularly sensitive to the interplay between geopolitical risk and macroeconomic indicators. For instance, while a potential economic slowdown in the U.S. might normally exert downward pressure on prices, the heightened risk of supply disruption from Russia provides upward momentum. This duality often results in prices stabilizing within a certain range rather than moving sharply in one direction. However, any unexpected escalation of conflict or a surprise in economic data could break this balance, causing significant market shifts. The rise in WTI crude by a larger percentage compared to Brent suggests that U.S. markets are factoring in domestic conditions more heavily. The anticipation of Federal Reserve policy changes and their impact on the U.S. economy directly influence WTI, which is more closely tied to North American supply and demand dynamics. Brent, by contrast, reflects the global picture, particularly European concerns over energy security due to reliance on Russian supplies. This divergence often highlights the regional nuances of the oil market, even when both benchmarks generally move in the same direction. Some experts argue that if the conflict in Ukraine continues to escalate, markets could see prices rising further as risk premiums increase. Others caution that if the U.S. jobs data indicates a significant slowdown, concerns about reduced demand could temper price gains. This tug-of-war between supply fears and demand uncertainties underscores the fragility of current market conditions. Investors and traders are therefore adopting cautious strategies, often hedging against potential spikes while also preparing for downside risks. The broader economic implications of rising oil prices are also worth noting. Higher crude prices generally translate into increased costs for consumers and businesses, contributing to inflationary pressures. For economies already grappling with inflation, this could complicate monetary policy decisions. Central banks, including the Federal Reserve, may find themselves in a challenging position if energy prices continue to rise while economic indicators suggest slowing growth. This delicate balance between fighting inflation and supporting growth is likely to dominate policy discussions in the coming months. At the same time, oil-producing nations may see the current situation as an opportunity. Members of OPEC and allied producers, collectively known as OPEC+, are watching the market closely. While they have committed to maintaining stability, higher prices generally benefit their revenues. However, excessively high prices could dampen demand and encourage alternative energy investments, so producers often aim for a balance that sustains income without triggering a demand collapse.